Hello, Ken. This is Richard. I purchased MRO, Marathon Oil, with a buy stop order at $15.20. On open, it took out my order and then immediately pulled back, period. Is there anything I could have done differently? Appreciate your time and effort. Thank you. Bye-bye.
Hello, Richard, and thanks so much for sending in your chart and your smart question. I certainly appreciate it. Your question, if I understand correctly, was you got filled at 1520 in this chart in Marathon Oil, and you're wondering if there's anything you could have done differently in the trade. And I've got two answers for you. Number one, the trade should still be alive. For a swing trade, it's less than 1.5 points stop loss. So if you look at our current charts, you can see even if you got filled at 1520, there's no way you would have stopped out at just 50 cents under the inside market for a swing trade. So if you're swing trading it, the first answer is your trade is still alive and kicking. I typically will use 1.5 points or 2 as a maximum stop loss. So if I bought 1520, the maximum stop would be a point down, which would put us right near 1370 or so. Okay, so that would be the maximum you would use as a stop loss, or a 2-day low, which is ever tighter, which might even be 1420. But even if you got filled at 1520, the trade would still be alive and healthy and continues to look good, right? It's a nice uptrending chart. So from a trade management perspective, that's still alive and doing just fine. From a technical standpoint, one of the things that you might want to start looking at differently in your trades is, why would you buy 1520? One of the tips to look at is to look at the opening pre-market range before you get into an instrument. So if you'd gotten filled at 1520, that would be right here. Okay, now one of the things I want you to start looking for is, before you put on a swing trade, what's going on pre-market? And if the pre-market price is above where your entry price would be, say if you used a buy stop order, you would cancel that order and instead use something that's above the pre-market high. So in this case, personally, I'd use 1550 or so, 20 or 30 cents or so above the current high. That would be the correct entry trigger that puts you in above the pre-market high. So don't buy if something's a pre-market gap up and then starts to drop. You don't buy there, which it sounds like you got filled in at 1520. Instead, wait for it to take out new highs above the pre-market high and put your buy stop order in. So if it were this morning and you see this data starting to show, you would move your buy stop order up to 1550 for either a day or a swing trade for that matter. It's a really good volatile chart, but that's one of the technical trading strategies I would advise you on, is to make sure you look at the pre-market chart. And even if you don't have a pre-market chart ability in whatever charting software you're using, you can still pull up your tape, your time and sales, and see what the real-time data is telling you in terms of the inside market and where it's trading before the opening bell. And if that price, say at 915 or 925, is above where you would normally want to enter on a breakout, don't trade there. Instead, wait for it to take out new highs above the current trading high. Okay, so the correct technical professional answer is, check your pre-market charts and always buy up in new highs, but never buy in a decline, because that means sellers are in charge. The good news, that's kind of the bad news, even if you got filled on a downtrend, the good news is the trade should still be alive and kicking, right? Because, from where I'm sitting, even if you bought 1520, if we look at your chart here, 1.5 points stop loss would still be way down here at 1370 or so. So you'd still be in the trade and long, and you can see that would have borne out correctly. That would have been correct because it's still keeping alive up here, right up to, as I'm speaking here, recording this live for you, it's right at 1520. So 2 tips: check the pre-market chart and then use a 1.5 point initial and trailing stop on the charts, and that way, even if it does get you filled, which is often the case, right? We'll often buy a new high and it pulls back a little. That should make you a little nervous, but not enough to close out a trade, especially if a swing trade is pulled back less than $1 or $1.50. That's well within the spec, or well within the limits of where you'd want to trade it. So it's still alive and kicking. It's a nice breakout chart, maybe worth another shot up in new highs if it continues on up to take out new breakouts. So anyway, thanks Richard for sending in the chart. hope that helps. A technical and a trade management strategy that I like to help you improve, your entries and exits and your timing. Because often you'll buy a new high, and even if it goes against you, it's not gone against you far enough to where you would stop out. It's still alive and kicking. And sure enough, it came back to life in today's market. So for that reason, use 1.5 or 2 for your initial stop. And also, I shouldn't have been buying. There's so much to learn about trading. So it's no mistake or anything, but just maybe a small technical error. But if don't make the mistake of pre-markets up here and you buy lower than pre-market. Wait until it breaks above whatever the aggregate pre-market and opening range breakout at 9:30 is, because only at that new high price is it likely to attract new buyers. Otherwise, if you're buying into a downtrend, which you got filled in a downtrend, it is likely to keep going down. In this case, just 50 cents or so, and it came back to life, so it's still alive and kicking. Anyway, thanks so much. I look forward to seeing your next video. Test that out. You'll see how well it works. And for all of you who are annual members at swingscans.com and tradingopen.com, I look forward to getting your video as well. So take care and best wishes for successful, active, professional trading in today's markets.
Good afternoon, Ken. My name is Damon. I would like to ask for your professional opinion on how one overcomes setting stops too close. For example, when I get into a trade, I will immediately set a stop, and I do so by reviewing the 1-minute chart, finding a support resistance level, and setting my stop slightly below or above that point. I know my initial stop should be 40 cents below or above my entry price, but my strong belief in your theory of taking small profits often appears to dominate the 40-cent initial stop rule. I'm not sure if taking small profits often is clouding my decision to believe in our pre-market analysis of finding strong charts and trading them accordingly with a 40-cent initial stop. For instance, I sent you a chart of UVXY where I was in and out of the instrument 3 times this morning with small profits in each one. Since I use interactive brokers, the commissions are only $1 a side, but I probably could have saved a couple of commissions using the 40-cent initial stop rule. As always, your professional guidance and input is appreciated. Thank you and have a great day.
Hey Damon, thanks so much for writing in. A really smart question about taking small stops in intraday trades and also taking small profits along the way. In general, I find it's much more effective to do exactly what you're doing, is take small incremental wins, even if it's 10, 20, 30 cents at a time out of the side of the chart, rather than use larger 40-cent or bigger stop losses. I think it's always a good idea to play as tight a game as you can and still make a profit as a trader. So looking at the charts here, I see the 3 trade setups. You made some relatively small, modest 10, 15 cent wins on the first breakout run of UVXY. I know at the live room normally we like to go for wins of 40 to 60 or 80 cents, but sometimes in summer trading markets, so the market perspective top-down approach, summer markets often tend to be choppier and you have to scalp a little more. So that's correct in terms of adapting your trading style to the market strength and what it's giving you. Another thing that comes to mind here is that, as you know, we teach using whole number exits, and so you can see you traded it all the way up into the 17 resistance, and that's fine. Now it looks like you said you got it initially at 1643, and on this chart that would be here on the first sign of a breakout, and that's fine. Oftentimes you'll see these gap continuations that stall out and then start to reverse course. If you get in and out of those correctly, as you did, that's a perfectly acceptable way to trade the market. The main thing you did correctly too was not buy over the 17 or at the whole number, because we know that things tend to run into resistance at whole numbers and then fade down. So I like your approach. It's much smarter to kind of nibble away like Pac-Man, take small profits out of the market on the way up. Even if you take 3 15-cent wins, that's kind of 45-cent trade the hard way. but it's much better to trade. And as you mentioned, using a inexpensive broker like Interactive Brokers that only has $1 a side commission makes it a kind of a non-issue. You don't really worry about getting in and out of the trade because it doesn't cost much to do that. So you're in the right direction of playing a tight scalping game that's better than using large 40 to 60 or 80 cent stops or whatnot. It's much smarter to take small bites incrementally out of the market because it all adds up. Kind of like the opposite of, we've all had that experience where you start off the week with a lot of cash in your wallet, and by the end of the week you wonder, where did it all go? Well, it was eaten up a little bit. You go out to lunch, you buy gas, you do grocery shopping, and by the end of the week the cash has gone out of your wallet. And where did it all go? In the opposite, what you want to do is trading is make a lot of small incremental wins. So even though these are really tiny trades, and as you know in the live room, our typical trading wins are usually anywhere from 20 to 30 or 40, as much as 60 or 80 cents. We like to go for bigger wins, but you did it exactly right in terms of on small grinding out new breakouts to new highs. That's fine, and you sidestepped going long at 17, so you made money on the way up and then walked out. And that's what your job is as a trader. Job number 1 is to keep really tight stops. Job number 2 is to take money out of the market on the way up. So you traded it correctly with incremental small wins. I'd much rather you do that. As a coach, I will tell you, it's much smarter to trade a tight game and play a tighter game rather than a looser game, because the tight game will keep you out of trouble and still do well as you did. So congratulations on making good small trades. A less capable trader would have, say, bet the farm up here, gone long 1,000 shares, got stopped out there and taken a big loss. At least you walked out of Wall Street with some small incremental gains, and that's much better than the alternative. So well done, and thanks for writing in. Look forward to seeing your next video and next question as well. And again, for all of you who are members, the annual members of my swing scans and live tradingopen.com room, you're always certainly welcome to send in your screen cap in audio or video, and I'll be happy to answer it, give you a good honest answer of how it actually works as a real money trader. So thanks so much for your submission. I appreciate it, Damon, and to all of you, do well out there in your trades. Take care and goodbye.
Hi, my name is Gabriel. I sent in an email about a current trade that I just ended today, which is Nugget, N-U-G-T, and I had a question about a stop that's volatile like Nugget. What kind of a stop that you'd put on that? Because I did exit, and wouldn't you know, by the end of the day, it went up.
Hi, Gabriel. Thanks so much for writing in with your question about NUGT. The question being that you got in somewhere near 102 and took a stop, and then it kept going back on up. Question is, did I enter at the wrong time? How much of a stop would I allow for a volatile stock such as Nugget? A couple of quick answers here for you. Very helpful, honest answers for trading instruments like this. The first answer is don't trade instruments like this. Personally, I only trade instruments in the $20 to $70 a share range. I may go as low as $15 or so, to $50, as high as $70. And the reason is exactly because of what you see here. There is no way you could have traded Nugget correctly, in my estimation, because it's just too dang choppy of a chart. I like to trade. I'll trade GD. If I want to trade gold, I trade GDX, and I trade Newmont Mining, and I trade Barrick. Not right now, though, because none of them are in a strong enough uptrend. So the technical answers are, number one, it's not in an uptrend, and there wasn't a strong signal to get into this. This is kind of an up and down choppy chart. So when it comes to trading charts correctly, you want to trade charts with good, well-established uptrends. Like MRCY is the type of chart you should be trading, or at least I like to trade, or Symantec, that has a nice continuous uptrend. You're just going to get in trouble if you fool around with charts that are up and down and sideways and choppy without a defined trend. And I think one of the reasons for this is not so much, it's not your fault, it's just that say Nugget's in the news a lot lately, and people may be talking about it in chat rooms or discussion forums. My advice would be stay clear of such places and instead trade strength and strong trending instruments, right? A good basic answer. So I couldn't have traded this thing correctly, and I'm a good trader. I could not have made money trading this because it's a choppy chart. It's kind of like the bad neighborhood where you're likely to get mugged. The right answer is, not to ask, how do I go into the bad neighborhood and not get mugged? The right answer is, don't go into the neighborhood in the first place. So I hope that helps. But, I teach traders at Trade Mastery and Day Trading University how to trade charts like this one, MRCY and Semantic being two of my recent picks that SYMC that my traders have gotten wind of. But it's so much easier as a trader. As a professional trader, your goal is to keep stops as small as possible and make as much money as you can, mainly by position sizing or scaling into trades in strong trending trends. A core part of successful trading is to make sure that you only trade instruments that have strong enough trends to where not only do you get into the first trade, but has a shot of giving you a second chance to get in on a continuous move by adding to or scaling into a trade once it moves in your favor, like this one, right? So a chart like this, I don't see any way you could have made money. And you could have day traded and scalped it a little bit, maybe gotten lucky, but why go through all that work? It's a very frustrating chart. So the correct answer is, and I found this in training so many thousands of traders, tens of thousands of traders now over the last 20 years, is a lot of times traders are just trading instruments they have no business trading in the first place because they're too choppy to have possibly made money. Kind of like going into a Las Vegas casino and playing roulette or something equally foolish. What you want to do is play poker against people who aren't as good as you are. That's the only way to make money in a casino. In trading, the only way to make money is to use real tight stops with real strong charts. So the correct answer is, you're saying today I sold the stock due to Brexit and it looked like it was going to go down further. I tried to keep a flexible stop as Nugget is very volatile, thought it would rebound. At the end of the day, it did go up. Did I enter at the wrong time? How much of a stop would I allow? I would not have traded this in the first place is the right answer. And you'll find that that's the case for many charts. If you want to trade potential money makers, you need to trade charts that actually have strong emerging trends that are likely to run. And that's why it's important to rely upon the community here at Trade Mastery and my alert services and all the rest of it so that you can get on top of the kind of charts that are actually suitable for professional trading. What you don't want to do is trade, say, old favorites. I used to trade Nugget way back when it was lower. I know it used to be a whole lot lower earlier, and it ran up nicely back in the day, right? Nugget's been, let's look at the 1 year chart. Nugget's been quite the runner here from early 2016 on up to May, but since I guess late April or so, it's kind of been in a sideways congestion zone. So unless it takes out new highs over say 130, I wouldn't be swing trading it because it's in a congestion chop zone, and it's kind of anybody's guess as to where it's going to go from here. And I don't know about you, but I don't want to guess and gamble with my trades. I want to make money. So the only way I can do that is to make sure that I'm trading charts that have well-defined trends. So whenever you see a chart like this, run, don't walk for the nearest exit. You want to trade charts that have a well-mannered, like doing an employee background check and checking references and seeing what kind of person you're about to hire. Look at the chart, and it will tell you whether or not you could have made money with it potentially. And if the story is an up and down sideways one, then you're best advised to, or at least in my own personal trading, I stay away from these type of charts and instead focus on ones that have a nice clean breakout, that has a continuous uptrend, that has strong entry and exit opportunities every couple 3 days. And that's a good way. A parting thought here is make sure that as you're looking at these types of charts, ask yourself, could you have made money in it had you traded it twice or 3 times during the last couple 3 weeks? And if the answer is yes, then that's a good candidate for a swing trade. Okay, so for more, be sure to see the members area at swingscans.com and tradingtheopen.com. But anyway, I hope that helps. The correct answer, and many of you, as you send in your own personal videos and so forth, for all of my annual members at SwingScans and Trading the Open, make sure that you're asking about charts that are the type that we like to trade, between $20 and $70 a share, at least 1 million shares a day volume, at least 1.5 points or so average true range or intraday trading range, and a nice clean trend that's easy to trade. So keep it simple, stay focused, and best wishes. Thanks again for writing in. It's a good question, And again, it can be frustrating. It can be. I used to trade these kind of charts because, well, it does have big ups and downs, but the peaks and valleys are uncertain, and it's very difficult to make money with that type of chart, as opposed to, say, ones like Symantec, where you could have just thrown darts at this thing and made money. That's the kind of chart you want to focus your energy on in swing trading. So thanks, and best wishes for successful trading. Look forward to seeing everybody's videos moving forward. Oh, hi, Trader Jagdish wrote in with a question about cyber, telling us that he bought it at 43.30 on a breakout, and it ran up to 47.28, then started to pull back, and he sold it at 46.20. Is there anything he should have done instead? So he bought here, and he sold into the pullback. No, I think well done. That's a perfect swing trade. Even if it does keep running on up to 200, you managed your entry and your exit right. You bought strength above new cut pattern highs, and you sold at the first sign of trouble. So that's the correct way to trade this type of a chart. So you did everything perfectly. There's nothing I would have done differently. Let's see, you bought 43.30, so on this chart that would be, looking at my own charts here, 43.30, nice wide candle at the right side of a bullish cup, so that's good for an entry. Or even if you waited above the 200 SMA, that's still a good entry at 43.50, 44. It ran all the way up here to 48 or so, and then pulled back and you sold at 46.20. That's perfect. That's a very good, it broke out, it pulled back, you sold at the first sign of trouble. I'd much rather you do that than trade sloppy and wait for it to see where it goes, because, this time it kept going up. The next time you trade, and we've all been there, we get into a winning directional trade, it starts to pull back, and we kind of play a game with ourselves and say, well, maybe it'll find support. And then kind of famous last words, it comes all the way back down to what you paid for it, and you get out without making any money or even take a stop in it. So to the degree to which you can get into breakout and sell the first sign of trouble, that's fine. As a professional breakout trader, what I'll tell you is, in the back of your mind, you should always be thinking, I can always buy new highs. And in this case, I guess if anything, I would say you could have rebought at 48.50 or so, right? So you'll find that your swing trades, and this is really important to get this, folks, is they're always cycling up and down, and you want to make money during the rush up and out at the first sign of trouble. Let it do its pullback or its trend reversal and go down without you, where you're all in cash, and then if it keeps going on up, you can rebuy above a cut pattern high. So that's the only thing I would have done differently, would just be to rebuy the new high at 48.50, then scale up at 50.5, 52.5, and so forth if it keeps running. But you made a winning trade, so that's good. Good for you. That's the correct answer. That's a professional trader's answer. Is nothing wrong with making. You won't go broke taking profit. So you get into a trade, it runs up, starts to pull back. Be fine with taking the money out of the trade. You can always buy if it does eventually come back to life. Oftentimes they won't, though, and oftentimes I found that my biggest winning trades in my own P&Ls and my own trades have been those in which I've sold at a price that feels early, but sure enough, that was near the exact top, and it kept dropping, and I'm glad I, made the money and dodged the bullet on the pullback. So if you buy here and sell there, that's fine. That's the kind of trade I do. So the first sign of trouble, you have not quite a bearish engulfment, but almost. It looks close to a bearish engulfment. Anyway, the point is, see a big red candle there, and it wasn't able to pierce the 48. Another quick tip is that often, from an exit standpoint, it's a wise idea to sell into whole number resistance. And in this case, you can see that illustrated perfectly. 48 was the hard top where it started running up. It started running up to 48 and then stalled and dropped right off to 48. So oftentimes when I'm in a swing trade, I'll close out the trade if it's within 50 cents or 70 cents of a whole number and it's not able to pierce it after a day or two. And you can see that was the case here. 3 days in a row, 4 days in a row, it tried but wasn't able to get over 48, and then it ran down 3 points. So oftentimes, to just price improvement on your exits, to make as much as you can, make as much profit as you can on your trades is the goal. When you get close to a whole number and it makes kind of a logarithmic curve, it starts to go sideways and the candles get flatter and you get some bearish upper shadows, close out the trade, sweep the money out off the trade, go to cash, and then use a buy stop order to automatically get in if it then takes out new highs. So that would be the only thing I would have done differently would be re-enter over 48.50. But you did a great trade, so congratulations. That's a good entry and exit dynamic approach that you're supposed to take in swing trades. If you keep doing that, you'll do just fine, right? You buy at one price, sell at a higher price, take a profit, wait for it to come back to life, and then re-enter the trade up at new highs. So thanks for writing in. I appreciate it.